Give you guys 5 minutes.
Or less than 5 minutes.
That's all right. How do you guys think you did? Okay, so let's go down to assets. Y'all call out to me the assets. Cash.
Land.
Land is one of them.
Accounts receivable.
Accounts receivable,
Supplies.
supplies,
Equipment.
receivable. Equipment, notes receivable is building, all good. Note receivable, inventory. Inventory. All right. What about liabilities? That's payable, what was the other one?
Accounts receivable.
Accounts payable, payable,
Unearned revenue.
unearned revenue,
Stock dividends.
dividends is the next one. That would be under equity. So the reason why stock dividends would not be a liability is usually dividends are under equity as, okay, we're paying them out. You can't have a dividend payable though. That is a liability where we stated, hey, we're gonna pay you guys, but we haven't yet. We'll put dividend payable. But stock dividends themselves would be under equity.
What's dividend payable? I'm sorry. I didn't
So-
hear what you said.
It's a payable account where, think of it this way, I stated, hey, I'm gonna pay you a dividend because you're my stockholder,
Mhm.
but I don't have the money yet. You're gonna have to wait a month.
Okay, gotcha. So,
Welcome in. So we're just listing everything from the trial balance. And just going from the very beginning. So. Any other liabilities that anyone can think of?
Wages payable.
Wages payable is another one. Is there a trick to some accounts for liabilities? Is there a trick to them for some of them? What do they usually have in their name to kind of say, hey, that's a liability? Payable. Yep. So every time you see a payable, automatically think liability. So equity. Said. Yep, dividends, common stock,
revenue.
revenue,
Expenses,
expenses,
retained earnings.
retained earnings. I think that covers most of them. Now, question. Does account receivable increase with a debit or decrease with a debit?
What'd you say? Oh, increase or, I'm sorry.
Increase with a debit. I know I said the question confusing, but I committed. So yes, it usually increases with a debit. Moving this one over, because this one has a better mic than this one, and I'll make sure. Ugh. We're on record, otherwise. It's my best attempt at a microphone. So. What about if I were to say, notes receivable?
Asset.
So,
Debit, but does it increase of a debit or increase of a
debit.
Sorry.
debit? That's all right. You're perfect in that it's an asset. So now what about equipment? Thank you, lady. All right, it does increase with a credit for common stock. What about expenses? They are debits. So the reason why they're debits, think of it this way, how does equity increase? Debit or credit? Credit. Now, does expenses increase your equity or lower your equity? So if you think of it like that way, knowing how it kind of affects with a debit and a credit shows, all right, it increases with a debit, but because it's under equity, it's going to decrease equity naturally. So what about unearned revenue? Debit or credit? Credit. Now, is there anybody who has any questions on any of this so far?
Oh, what is under assets? What is the I and B? Is it?
Oh, inventory.
Oh, inventory.
Yes, if there's anything on here that is questionable, us accountants, we very much love abbreviations. Now, I understand not all abbreviations translate very well, so if anything's confusing, just let me know. All right. So, let me actually grab the notes. And let's start going through. So, can anyone list the external users of the financial statements? Customers, investors? IRS is definitely one of them, government. What about what? We got one more. Stockholders or our investors? But still good answer too. I'm looking for one more category of people. Who looks at our financial statements to know if we're a good company? Huh? Managers are our internal ones, actually. So those are actually our internal users, but our external ones, so far we've listed investors / stockholders. We've listed government, aka IRS. Anybody else that falls under that category? Yes.
Financial institution.
Financial institution, they are lenders. Anybody who wants to give us money, they want to see, are we worth it? Otherwise, they will send us outside on the curb. Our managers and anybody that's within the company are technically our internal users. They are the people that will basically look at it to see if it's profitable and see what they can do to improve the company and thus improve our gross profits, so on and so forth. So, a good question. Do we have to be ethical as accountants?
Yeah.
What holds us to those standards?
GAAP.
GAAP. Does anybody know what that stands for?
You know, it's a-
Perfect. So that leads us to the next best thing, our principles and our assumptions. So I'm gonna start listing some scenarios. Bless you. You guys gotta let me know, and I'm gonna list them out on here on the board first. That way we have them kind of just all right. Bless you. So we have the measurement principle. Bless you. Revenue recognition principle. I'm shortening principle for friend, just because we're gonna go, keep using it for a moment. Bless you. As well, now that I'm getting into the assumptions, I'm gonna shorthand that as well, but they're all assumptions underneath. And out of curiosity, does anybody feel fully confident knowing these principles and assumptions? Don't worry, I was in your shoes too. So. Before I start getting examples, let's run through these. So the measurement principle, does anybody have a good definition for that? Does it have to be the word for word, just something that they understand it as? Anyone? You're close. You're actually talking about the monetary unit assumption, which they both have money in them. Those are very confusing. The best way to think of that one is knowing that, hey, we're assuming, we assume we're doing dollars.
Which one?
So we're going for the measurement principle. The measurement principle. Anybody have another guess? Any wild guess, doesn't have to be right. You only learn from wrong answers. Perfect. So measurement principle clearly states the value that you bought it at, no matter what you think, is gonna be exactly what it is reported as. You cannot record something that you think is $20 more than it actually costs, because otherwise GAAP is gonna come at your throat. I make them sound very, very mean, but they're not. So what about the revenue recognition principle? Anyone feel confident in giving me an example of that? What do you guys think when you hear revenue recognition principle? Now, exactly when is it earned?
Reporting revenue before. Oh, no, after the service is given, right?
Yes, and only when the service is given. Are you saying that as well? You're very far back, so it's harder to hear you, so I'll try to move around a little, but For the revenue recognition principle, the moment you do service is the moment that you record service, no matter if the money has been given today, tomorrow, or yesterday. Whenever that service is done, that is when you say, hey, we have a credit for revenue. All right, expense recognition principle. Anybody having any big ideas for that guy? What do you guys think when you hear expense recognition principle? You have any? You're good.
You say for revenue, you say you gotta credit it. You always credit.
You always credit revenue, and you always do that credit the moment the service has been done and no other time. So. No one has any answer for the expense recognition principle?
The expenses reported to show how much revenue you made, kind of.
You're close, yes. You wanna, it's also known as the expense matching principle. But the biggest indicator for the expense recognition principle is knowing that you expense when expenses are done. So for example, with supplies, when we buy supplies, we don't expense them out until we use them up and we toss them out. Another example is wages. We have a wage payable account that will always be matched with a wage credit account. And I'll actually write this one down. Also, if this is very far, it's on the back of the board as well. I have it everywhere. Anyway, so the wage payable and the wage expense, basically this is all controlled by that expense matching / recognition principle. The biggest reason is we expense when we expense. These people had worked hard for their earned money, and we can't pay them till next week, but we have to recognize that they worked hard for that money. And we are going to give it to them at some point. So,
Matching expenses with credit, you said?
yes, oh wait, shoot, I'm so sorry, you don't credit expenses, that's all on me. I'm still thinking of revenue. Thank you for calling me out on that. Sorry, y'all.
So it's a debit.
Expenses are always debited. Expenses are always debited. That was me not thinking right. And payables, they increase with the credit. My mind was for some reason on revenue and thinking that they were the same for a hot second. But the same goes for anything like we learned about interest recently. Now, that was through the receivable end, but if we are to owe interest, but we're not paying it out yet, again, we would expense our interest and then we would put in interest payable. So we do interest expense and then interest payable. I did it right this time. Now, anyone have any ideas for the full disclosure principle?
It's not withholding certain financial documents, right?
Perfect. Basically, think of it as our disclosure, our footnotes. That's the basic nitty gritty to say, hey, this might look odd, but this is why. We put it like this because of X, Y, Z, and it's all of those little nitty gritty footnotes. What about the going concern assumption?
That's assuming the business will still exist.
We're going to keep going as if we have no concern. That's the best way I like to remember it. I see a lot of y'all writing, so I'm going to stop for a minute. That way I don't keep going too far ahead.
So the full disclosure principle, I just like.
So, have you ever looked at a contract and saw like very, very small letters at the very bottom, some kind of thing to indicate something? Basically, it's something like that. Hello, welcome in. We're talking about principles and assumptions. The fun nitty gritty. So. With a full disclosure as well, think of any kind of contract you looked at. Like the rent contract, sometimes they have to disclose information like, hey, we know that there's a leak there, we're aware of it. That way, you're able to move in here without finding a leak and saying, hey, no one told me about this. But instead, you're thinking about the financial statements. Where a business may have borrowed a large sum of money, but they're saying, well, the reason why we borrowed this large sum of money isn't because we're losing profits and need to keep afloat. We just wanted a new building because we thought that profits would skyrocket. Does that make sense?
Yeah.
Cool. Any other questions on the ones we've done so far? Perfect. So what about the monetary unit assumption?
Money will be there when you need it.
That's a nice way to think. So, does anyone else have another guess?
Other the transactions are expressed through the monetary units.
We think they're gonna be in dollars. But that's perfect. Yeah, whatever we assume that the transactions are gonna be in. So if we were in Russia, we would think, okay, that's gonna be in rubles. We're gonna understand money as we understand money. So the monetary unit. What about the time period assumption? Anyone got any guesses? Something like that. It's more or less, we split up the year between the time periods. We know that we go through this financial year with 4 different quarters. So we have quarter 1, quarter 2, quarter 3, quarter 4. This one's a little more trickier to kind of explain through kind of free form. But the life of the company can be divided into time periods, such as months and years, and useful reports can be prepared for those periods. So basically, whenever you see time is involved, that we're expecting not expecting the business, but we know we prepare financial reports at these certain times. That's when we're looking at the time period assumption. What about the business entity assumption? Anyone got wild guesses? You have one? Hey,
It's like the business is separate from the clients, I guess.
close. The business is separate from the owner.
Oh, okay.
So basically, if I own my company, I can't go around with my business card and buy what I want. I can't go grocery shopping with the money that's straight from the business bank account. If I were to do that, I'd have to pull a dividend out and say, hey, this is my chunk of money and I'm gonna spend it how I wish. Does that make sense? Awesome. So now that we kind of went through a rundown, we're gonna go through some examples. So. This one's an easy one. I believe that my business is gonna keep going for the next year. I don't plan to close my business down for a long time. Going concern. All right, I'm expecting to pay $5 for the sandwich. Monetary unit, I'm going for dollars. I'm not expecting to look at rupees. Now, following that, on the business documents, on my financial statements, I am expecting to put $20,000 down for my truck. I think I got a great deal on it. That truck was probably worth $40,000, but my next door neighbor, it looks stinky, so he thinks that I paid too much. Measurement principle. Now, that same next door neighbor gave me $100, said, I'm gonna go cut their lawn next week, but I'm not going to put revenue down on my financial statements yet. And instead, I'm gonna put unearned revenue. Revenue recognition. Now, we'll say it's opposite way though. I did that lawn and they haven't paid me yet. I'm expecting payment next week. but I recognize my service. Huh? Non-expense recognition,
So,
still revenue. That's a trick question on it.
oh, because you already offered the survey, okay.
So these are two different things, but they're both revenue recognition, where one was where I was paid beforehand, and I'm not gonna recognize revenue till later. This time was, I haven't been paid yet, but I'm recognizing revenue now. So both cases are revenue recognition principle. Now, we'll keep going with the mind's set of expenses though. What if I technically haven't paid my utilities yet? They gave me the bill. I haven't paid it yet, so I'm gonna record a utility payable and a utility expense. Expense recognition. The trick to both of those is knowing one's of expense, one's of revenue. If you hear revenue, automatically look and see if it's revenue recognition principle. If you hear expense, think of it, think of the expense. Does anyone have any questions on any of these? Or this help them kind of solidify them?
Can you go to the full disclosure principle?
Yes. So think of the full disclosure principle basically as, all right, I know that some of my financial statements look a little funky, and in my footnotes, I'm gonna say why. I'm gonna tell them exactly why, or I know as a good business owner, there's something wrong here, but I'm gonna tell them why instead of pulling the blinds over them. Think of it kind of like when you go to rent somewhere, where usually in their contract, they'll let you know if they know of something wrong. So the sink is leaky, we know we're gonna fix it later, but that's gonna be after you move in, kind of deal. We put that in the footnotes so that you are aware of them and that no one can come back and sue us. So basically the leaky sink of the financial statements. Yes.
So is that like showing the side effects of medicine?
Yes, actually, perfect. It's the side effects of the financial statements.
So time period assumption is just assuming that all of our, like, all the statements we have and all the information are pulled just from that year or that quarter.
Yes.
Okay.
So anytime it's dealing with, all right, quarter, year, or month,
Mhm.
that's time period. All right. Anybody else? We're ready to move on. All right, I'll take that as my cue. So I've already ran through assets, liabilities, and equity. Let's run through financial statements. We're gonna go through just the bare bones of them at first. We'll do some more bigger questions after we get through all the content in chapter 1. But as far as it goes, does anybody off the top of their head know the income statement? Revenue minus expenses. What does that equal? Net income. All right. So what's the next financial statement? That comes right after. Statement of retained earnings. All right. Now, how do I do that? Beginning retained earnings. What comes after that? Net income adding or subtracting? Adding. What's next? Minus dividends. What does that equal? Ending retained earnings. Can you ever do retained earnings before doing the income statement? Perfect. What's the last, well, not the last, what's the third to last, financial statement? It's balance sheet. What is not on the balance sheet?
Retained earnings.
Retained earnings is on the balance sheet.
It's different.
Dividends, expenses, we're missing one more. Revenue, perfect. Why are they not on the balance sheet?
Could be out of
Yep. These accounts got eaten up by our financial statements and they're gone. They are on the trial balance now. So we're just gonna do. And we don't need to know it, but what's the last financial statement?
Cash flow.
Perfect. Statement of. cash flows. Any questions on any of the financial statements? Perfect. I'll leave this up for a second.
There's three, right?
There's four.
Or four?
So the last one is statement of cash flows, but you guys don't need to know the bare bones of it yet. And if I were to write it down, it would take much more than this whiteboard of what I've given it.
What's the third one?
Balance sheet.
Balance sheet?
So we got income statement, statement of retained earnings, and then balance sheet. So. How do y'all feel on transactional analysis? And does anyone not know what that word means? Perfect. All right. So transactional analysis are basically, and is anyone still writing anything from here? Before I erase it,
We got it on
which one?
the bottom right one.
Statement of cash flows. Statement of cash flows. Right here? Oh, wait, right over here? Balance sheet. And then we have assets, liabilities, and equity. Anything else? All right, I'm erasing it. So. Transactional analysis is where you notify what accounts are gonna be using and whether they're going to affect your assets, liability, or equity. I'm gonna put up 3 different examples here. I'm gonna set up kind of a grid. And I'm gonna give you guys 3 to 4 minutes to do them on your own before I go over them. I'll leave this here for now. And give you guys a couple minutes.
What what are we doing? I haven't seen this before.
So what you're doing is you're gonna be listing the accounts you're gonna be using and then saying, are we increasing or decreasing assets, liabilities, and equity? So we'll run through one of them first, and then I'll just put a new one down here. Kind of work for it. So we'll do the first one.
What's the amount of dog for the
Right. We'll say 30,000.
building?
I've never bought a building before, so I'm just making guesses. So, first transaction says pay cash for repairs on equipment for 1,000. What accounts are we using?
Good reach.
So we're using cash. Perfect. Are we debiting or crediting cash? Credit.
Did you say credit?
Yes.
Why is it credit?
Do your, so does your assets increase or decrease with debits or credits? They decrease with which one? They decrease with credits, and right now, yes, they paid. If it's hard to see, we also have a thing on the back too.
No, I saw it, I just wasn't.
That's all good. It's a Monday. So, what other account are we dealing with? Huh? What kind of? What are we doing to the equipment? Because we're not just buying equipment again. Repair. So, it'll be a repair expense. I don't know why I decided to be fancy. So, what's gonna happen to our assets? So are they gonna go up or down? What about our liabilities? Nothing. What about our equity? Exactly. So that help make sense? So think about it this way. How does equity increase with a debit or a credit? Equity increases with credits. So repair expense increases with debits. We are debiting our repair expense. And though our expenses themselves are becoming increased, this is actually going to lower the value of our equity. Second, we might be getting a Zoom person. All right, so number 2, Sammy invests 8,000 cash in exchange for common stock. What are the accounts we're dealing with? Cash, common stock. What's going to be debited? What's going to be credited? Is that debited or credited? You would not debit common stock, actually. You're going to credit it because we're increasing our equity. So what does that mean for cash? Cash is going up. We've just been invested. So the company, yep, we're debiting cash. think of it this way. So equity is one of the financial instruments that we use in accounting to dictate that we are investing in our company through means of our own, through contributed capital or earned capital. Earned capital would be our retained earnings. Our contributed capital is our common stock. That's where people just say, hey, here's a couple grand, just pay me a dividend sometime, please. Well, we have liabilities, which is where we finance our business through debt. So that's gonna be every payable in the book and our unearned revenue and so on and so forth. Which is things we have to pay back in rather a monetary or service fashion. So what's gonna happen to our assets? What's gonna,
It's different like on the one, because I've seen like a question where it's like where the company owner invests cash in exchange for common stock.
same thing.
Same thing.
Was there something different within it? Or
No, I don't know, maybe I got mixed up.
it sounds odd because. Oh, sorry, I thought you were talking. It sounds odd because like at first you're like, hey, the owner's investing, so we're giving them common stock, but that also works with shareholders too. The thing is, the owner himself is a stockholder. The thing is, he just owns most of the stock. So what about liability? Nothing. Woo. Got a couple people. Yes, this is why we're taking it. We also have markers. If anybody wants markers, we're running out of them, but we got markers. So. What about equity? Increase or decrease? I'm hearing a whole mess. Increase. It's going to increase. We are basically making tally marks of that common stock saying, all right, since someone invested in our company, we're increasing our equity with the fact that we have more contributed capital that's holding our whole assets together. Does that make sense? We only have like two, they only gave me like 2 rags, so if you need a rag, they're around, we're passing them around. So, and just making sure everyone checked in over at the welcome desk, right? Perfect, just gotta make sure. So, we took a note out to pay for a building for $30,000. What's gonna be our journal entry? Is that gonna be debit or credited? What are we debiting? Bills. Perfect. All right, what's happening to our assets? What's happening to our liabilities? Perfect. And anything happening with equity? This is a good kind of follow-up of examples where these are our financial devices. Especially here where we're financing things through our equity and then we're financing things through our liabilities. Just one of them we have to pay back. So any questions so far on any of this? Oh, perfect. All right. I'm gonna make up a trial balance then. And we're gonna all work on some financial sheets. So we'll run through the income, both the income, the statement of retained earnings, and the balance sheet. I'm gonna give you guys around 5 to 10 minutes after I fill out the sheet to work through all that, and then we're gonna move on to chapter 2. Need more of mine, I'm not being good anymore. You guys can use a sheet of paper, use a board. We got a couple markers left, and if I need to, I will run up and grab more. And maybe they might give me some more rags too. The company, or the companies. Phone out. Also.
Is Facebook supposed to be on the phones?
Huh?
Oh,
Oh, we only have one. I just, the tail dragged a little.
okay.
So that is an account payable.
Oh.
Oh, welcome in. We're practicing our financial statements. We're gonna practice all of them. I'm just setting this up. So this is gonna be all of the information. And then we're just gonna work down. We're up to right now. Let me make sure everything adds up real quick.
$28,000.
Common stock is 20,000. All right. I'm gonna give you guys about 5 to 10 minutes to make this into an income statement, a statement of retained earnings, and a balance sheet. And I made sure everything is equal, so this should be a very valid trial balance.
So it's just like, yeah, so it's income statement, leader names and balance sheet.
Yes.
Okay.
And if anyone has any questions, just raise your hand, I'll come by over. So this is definitely something you will see on your test. Hi, welcome in. We're working on financial statements. We got all the information. Just make yourself an income statement, statement of retained earnings, and a balance sheet. We have markers. I might take this moment to go run and grab more markers. I got two.
I guess so.
We have some. Yeah. Use your own sheet of paper or the board, whatever works best. I'm gonna at least take this moment to real quick go run and see if they have any more rides they can let me use.
Yeah.
They spared a few to go around. Yes.
You got the billing expenses, 30,000. You consider this over 30 years, 1,000 out of years, or how are you breaking it out?
We're just worried about what's gonna be on there right now. We're not gonna worry about depreciation. When we're gonna be dealing with depreciation, it's gonna be chapter 8. So you're ahead of us.
Well, I just thought, you know, if we're being input this year, we got 30,000, you can say negative 0. We got really nice next year.
Okay. Oh, yeah, yeah, yeah. The last range we're at.
There's gonna be now, we just said it. Yes. Also, I had to change the representative to 12,000 and make it balance. So you're just gonna have to put like 4,000 off of the ending. Make the top 12, make the bottom. And it's gonna be 4 now, so. You got it updated, so the 12,800, that's it, that's perfect. Every table should have. We have one more marker, yeah, don't mind. But we're just using this, basically make an income statement, statement of retained earnings, it's a brand new company, so there is none. Yeah. Huh? No, so as long as you're able to get there, like on the test, you might need to, well, honestly, even so. Setting it up is. Yes.
So we're just.
So we don't, I guess. Oh, it's not up there.
So it's got, yeah, it's just income statement, senior earnings and the, balance sheet. Yep, you need to know how to do that because. Without looking at it. So that's why I'm doing this. Of course. Yes, you can zero for those. I love making good questions. We have one more marker if you want to write all over the board. I'm just saying, if anyone at any point says, hey, you wanna admit someone in here, let me know. I've had like 2 emails say, hey, we wanna come join the Zoom room. I've seen no one, so I just wanna make sure I'm not going crazy. Yes.
Yeah, okay. We're not considered rather. Okay, I'm not having to use all the.
This is all correct. You wanna say, you're gonna perfectly see your balance sheet. So.
Yeah, it's something.
Yes, yes.
Yeah.
Yeah, we gotta add.
I'm gonna get 3 more minutes and then we're gonna get started on that income statement.
Yeah.
You have a good one, sir. We're gonna be posting this up on YouTube as well, the group study. Yes, I believe. Are you part of the secret group? There should be email ready with a study guide and with the YouTube channel itself. So the YouTube's just gonna upload itself. Well, have a good one. Yes.
Yes.
This is why I should have made down.
Well, yeah, that's. But you like.
Are you talking about the income statement?
Yeah, then I just find it empty. Okay. As long as you guys can separate.
Yeah, it's done what,
Right, we gotta do.
Oh,
yeah.
I would rather.
Yeah.
And so. Other people will work. Just this one, right? Yeah. Just grab my first name. I don't. Yeah. And you get that.
They both think there's only money.
Series of retained earnings.
Oh, that's perfect.
So,
Nope.
so zeros into the income.
Yeah.
So it should equal, what's that right now? It should equal. Here's the right.
But it's not on there, it's immediate.
Okay, you're good, you're good, you're valid.
That's what I'm saying.
So
It's not.
You just skip the,
It's not anything here. I'm assuming it's like this area.
So then you have, so you get that.
Yes.
Exactly.
That's how I'm trying to picture it.
That's why I always
So from
like
the
bring it
income
up.
statement,
I will
that
never
everything
not.
that's somewhere in the
Maybe
negative.
that is.
Next.
It's for it.
Okay, alright, so we know. It's dividend, yes, it's starting that one, so then we will pay for.
That was
Any
the
earning.
If you still got the. There's not.
Yeah, I guess, I guess.
It's higher than that.
Number.
All right, y'all. We're gonna go ahead and start working this out. So, first things first, what's the income statement?
Revenue minus expenses.
Perfect. Now, what is our revenue? Our revenue is 12,800. What is our expenses? Yeah, 1,400 altogether. Typically, when you're doing these income statements, though, make sure you separate them all out. That way, it kind of, one, it makes sure that you have everything accounted for. And two, the professors always want to see them all separated out. Who has our income statement? What was it?
11,400.
11,000 for some reason I thought I heard 9,000. All right. Statement of retained earnings. What is our formula?
Beginning retained earnings plus income minus dividend.
All right, so did we have our beginning retained earnings?
No.
Brand new company. Now. Do we have a net income?
Yes.
Got it from the last one. What about dividends? Did we pay any dividends? Sometimes you just don't pay people. There's our new retained earnings. Now. Move this a little bit and we're gonna go to the balance sheet. So what accounts are going in our assets?
Cash, accounts receivable,
Cash, accounts receivable,
supplies, equipment, building.
all right. What's our total assets?
71,800.
71,800. What about our liabilities? What liabilities we got?
Accounts payable.
Payable,
That's fair.
it's payable, unearned revenue. Does anybody have our total liabilities?
32,000.
32,400. Now, what about equity? What's in our equity accounts? Common stock, retained earnings, anything else?
Do we ever?
No, those are all disappearing. If we put them down again, it'd be like double dipping since we just kind of folded into a sandwich.
And that's why I do that.
All right. Everyone? All right, what's our total equity?
39,400.
39,400. What is our total equity in liabilities?
71,800.
71,800. Is it important that it matches? Good.
So what's
Yes.
On the side, we have to put like the total liability.
You might not have any that nitty gritty, but it's always good to put. One, it helps check yourselves, and two, it helps kind of bring a good. All right, any questions on this? Nope. All right, let's move on to chapter 2. So we don't need to know all 9 steps of the financial cycle, but I mean, the accounting cycle, but we will need to know the first 4. Can anyone tell me what the first 4 in the accounting cycle is?
Transaction.
Analyze transactions. All right, record journal entries. Does anybody know step 3? Post it. Post to ledger. We're missing one more. Trial balance. We prepare the unadjusted trial balance. You will need to know these in order as well. We know, first, we take our papers, our transactions, and say, ah, yes, these are transactions. We then need to record these in as a journal entry. We have to say, all right, cash debited the credit revenue. We did service, y'all, we got paid for it. Next, you post these to your ledger, aka T charts. And then you make that little unadjusted trial balance, which mine was technically adjusted, but that you're gonna learn that in chapter 3. But a trial balance is basically what I threw at you guys before the financial statements, where everything is just listed. Any questions on any of this? Yes.
What is step 2 again?
Step 2 is record journal
No,
entries.
no, what are these steps 2?
Oh, analyze transactions, saying, ah, yes, transactions. Recorded journal entries. Post to ledger, which is your T charts, and then prepare unadjusted trial balance. Do we all know what an account is? So what is an account? No, but it's what kind of formulates them. So your accounts are basically it's basically a record of all increases and decreases in an asset, liability, equity, revenue, or expenses. But it's basically that saying, all right, cash, there's our accounts. Accounts receivable is another account. Common stock is another account. All of these are basically title placeholders to show value into something that has happened. Do y'all know what a ledger is? Ledger is going to be record of all accounts and their current balances. So that's where we would have a page that has a whole bunch of T charts signifying, all right, we've credited, debited, credited, debited, 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 credited, debited, credited, and the ending balance of it. Welcome. A chart of accounts is a list of all ledger accounts with identification numbers. Yes. Oh, do you have a hand raised? Okay. So you will need to know the definitions of assets, liabilities, and equity. So can anyone tell me what an asset is?
It benefits the company.
Resource and benefits the company. Perfect. Both of them are correct. Liabilities, what is a liability? Perfect. What about equity?
Total ownership of the company.
Perfect. Yes.
So this test is it gonna be like a skin tone test or it's gonna be like written?
So. Are you for Jaegers or blockers? Both. She is a much more writer heavy. She's gonna have a whole bunch of journal entries.
Okay.
They're ready to go and run these journal entries. So, and do we know the rules of journal entries actually? That's feeding right into it. Do the debits have to equal our credits?
Yes.
Can there be more than one account? I mean, 2 accounts used.
Yes.
Can we only use 1 account? Nope. So. And how do we feel on debits and credits? Great. Anybody feeling kind of iff about it? A little bit? Something to know, and one of my very loved resources I like to use is Dealer. We have our normal T chart here. Everything on the left. increases with debits. Their normal balance is a debit. So if you ever see something say, all right, our expenses increase, we're gonna debit expenses right off the bat. Whenever it says, all right, we're gaining more assets, we're getting more cash, we're buying a building, we know that is gonna be debited. Same with dividends. The moment you see dividend and you have to put down a dividend, you'll know debit. Now, the opposite is true. Liabilities, equity, and revenue. All three of those will increase with credits. So the moment you see, all right, we invest in the company for common stock. Common stock's gonna be credited. All right, we're earning revenue, credited. All right, we owe someone, we have to pay something, credited. Until we pay those things back and decrease those balances, we won't debit them. Any questions? Okay. So. Before we run into journal entries, I'm going to. And I'm gonna erase this. Anybody need this still?
Yes.
So I'm gonna throw some accounts up here and we just need to tell me, do they increase with debits or credits?
Right, you're here to afford that.
Yes, I'm here to force.
Yeah.
And it's also all being recorded if need be.
I think those three. Okay. I will increase these.
Yes.
Here is some increase. I just have to remember. Oh, that's because that's sort of you feel like the number and put a second number. Yeah. Yes. Yeah. They might have this. And it's like. Right, so. And yeah,
Yes.
And then, oh, yeah, she made sure she emphasized on, you have, yeah, that's what it's about.
All right, we'll start off with prepaid rents. What is it?
Accident or the.
Asset and debit. It increases with a debit. Second, let me move this down slightly. Oh. We increase with a debit. What happens when we credit? Decrease. Thumbs up. Credit. What happens when we debit? Decrease. Equipment. Unearned revenue. Utility expense. I heard of mix. Debit. Expense. Interest, revenue. Credit. Allowance for doubtful accounts. Credit. We decrease it with a debit. It can have a debit balance at the beginning, but the only reason it has a debit balance is because we overuse that account and we have to fill it back up to its normal credit balance. So accounts receivable.
Yeah.
Debit. All right. Anybody need this up still, or can I erase it? All right. Just kicking this thing around. All right. So I'm gonna throw some scenarios. Y'all are gonna tell me what's the journal entry. So invests $2,000 into a company. Now we're crediting or debiting? Credit common stock. Like the same. What are we debiting? Cash. We borrowed $5,000 from a local bank. It's payable, credit, or debit. And what are we debiting? Yep. We purchased $1,000 worth of supplies on account. Accounts payables, and what was it? We wouldn't credit cash if it says if we bought it on account. That's okay. It's hard, I know my words mix up too, so it's. It's account payable. And what are we debiting? So what if we purchased land for $3,000, paid $800 down, and borrowed the rest by issuing a 2,200 one-year note? Land is debited. What was that? I can't hear you. You have to speak up, but sorry.
I don't know the driver.
Cash is credited. How much? Perfect. And what else is credited? Tax payable.
Notes payable is credited?
Yes. I'm making this very obvious.
It
Yes.
doesn't matter how many credits and debits there are as long as they equal it.
Yep.
So there can be just one debit, which is in land, and then 4 credits, but as long as that equals debit, it's all good.
Exactly.
There be multiple debits.
There could be multiple debits. Let's say this. I went on a shopping spree today. I got myself some equipment. I got myself some buildings, and I paid it all on accounts with on account payable, my credit card. All that's going to basically look like. Yeah, a building. Equipment. Well, it's just saying it's payable, because that would make more sense.
Loaded your black card.
I know, I'm gonna be hanging this off for a while. Does that help make sense?
Yes, yeah.
Any other questions on journal entry so far? Always debit. If you notice here, there's a big trend, and one of the big things to keep in mind too, it helps make things kind of more distinct. Because if we started mixing them together, it would just go into a modge podge, even with like the 1 and 2 here. We do this especially for organizing. And I don't really think much else. Besides just helping it be concise and also being GAP approved. GAP says this exact order. Right? What if we paid a dividend? We paid a $300 dividend to the company owner. Okay, what's our debit?
Dividends.
Dividends. What's our credit? All right. Is there any account that anyone has any trouble with that they want to kind of run through? Besides, obviously, chapter 7, right before we hit over to chapter 7. Our favorite chapter. Yes. How about y'all in the back? Everything all good?
Can you just like read the problem?
Yeah, of course. So the owner invests $2,000 into the company for common stock. Huh? So, number 5 was basically I went on a shopping spree. I took out a note for both the building and equipment. And so I took a $50,000 note. Building was 40,000, the equipment was 10,000. So for number 5,
Yeah.
I took out a note for $50,000 and paid that, I used that to pay for a building for 40,000 and equipment for 10,000.
Question. What's the difference between 1 and 6? It sounds like it's the same thing as buying something. But on 6, you're crediting.
So 1, we're not buying anything. 1 is where the owner says, all right, I'm gonna start up a company. I need $2,000. I'm gonna move $2,000 from my personal checking account into my business account. And that is considered a owner putting cash in and taking out common stock. Mhm. And so with number 6, it's where we're saying, all right, you know, make some good money. I'm gonna take $300 out to rather give to a stockholder or the owner takes it out. Either way, it's a we took out a $300 dividend. And that means we no longer have that cash.
Okay.
Does Bob have 2 assets?
Huh?
Does Bob have 2 assets?
5 does have 2 assets. It's to show, 4 and 5 are to show you can have multiple debits and you have multiple credits. It just depends on what the situation is, yes.
So, you did that word.
Purposely.
So, debit and credit are separate?
Yes. You wanna make them obvious because debits are always intended a little bit further. Because if you look, so the best way to ever know journal entries, in my opinion, is to take a whole bunch of journal entries and try to guess what it means. If I was looking at a accountant's book and I saw just this, I could tell you exactly what happened with everything. I like to say that the journal entries are the angry accountant's diary entries. For the sheer fact that you can read their whole day.
Did you always have money?
Unless
You do want the dates. It depends on the teacher if they're gonna be extremely heavy on wanting you to date or to date them or not. I think with Miss Blocker, she's a lot more harsher with it. With Miss Yates, as long as you get the journal entry, she's fine. But if you're going to the accounting field, oh yeah, you want dates. All right.
What would putting like allowance for doubtful accounts look like with your journal entry?
So we're gonna go over that in chapter 7. So after this, we're moving on to chapter 7. Yes.
So for number 1, unless like the example says, just use.
So yes, though for number 1, you never see that. So you never see like, okay, on account, if the owner is investing money into the company, it's always gonna be money. They can invest equipment, they can invest in building. It really just depends what the owner says here, have this, and I'll take common stock. Now, if it was like accounts receivable, if you're thinking of, is that the one you're thinking of, or accounts payable?
I looked at like in general, because I didn't realize that it was.
Whenever,
Yes, because-
whenever you're reading it on like the test or anything, it'll usually tell you exactly what they're doing. So if they say, hey, we invest this amount of money for the company, if it doesn't say anything else, it's always cash. And usually if it's something account, they'll say account, and you have to determine, is it a receivable or is it a payable? Does that make sense? Any other questions before we move on? How are we feeling on material from chapter 2? All right. Anybody need this up still, or am I good to erase it?
Yeah.
So while this is erasing. Do we all know what account receivable is?
Asset.
It's an asset. What exactly is its definition?
It is money that is owed to you by a customer or somebody who's paid something to you. Or no, that has not paid somebody.
Perfect. It's money that other people owe us for the services we have given.
On credit.
Or stuff we sold.
Huh?
Or things we sold.
Yes, or things we've sold. And
It's on credit.
on credit, if you hear like, okay, we did a service on credit, immediately think accounts receivable. So if it does not say, hey, they just handed you cash, then it's account receivable.
Prepaid anything, if you hear the word prepaid, rent, insurance, or anything like that, it's automatically an asset.
Perfect, yeah.
Okay.
So. Can anyone tell me what a control account is?
Made up of like subsidiary accounts.
Yes. So the main thing that is made up of subsidiary accounts. So that's account receivable itself. Is the control account. So can anyone tell me what a subsidiary account is?
Money accounts inside it. Customer.
Tiny accounts inside of it. So it'd be like if you looked over here and just, you saw these numbers, but immediately think, oh, right, Bob owes me $100. Billy owes me $200. Sherry owes me $300. But over and all, our accounts receivable total is $600. Does that make sense? I'll take the silence as yes.
Said there's subsidiary accounts?
Yes. Real quick to make sure we have the journal entry down. What's the usual journal entry for when we do services on credits? Debit account receivable. What are we crediting? Revenue. What principle dictates this? Revenue recognition principle. So, whenever we do sales on credit cards, do you guys know the reason why we do them and why we do them? Drives up sales. It's easier,
Less risk.
less risk,
You get paid right away.
paid right away.
You should add your 3 to 5% to every credit card sales that they pay it.
Yep, they pay the tax. All right. And now let's get into the fun of uncollectible accounts. So the direct write-off method will not be on the test for at least Miss Yeager's class, for Miss Blockers, or I believe I have some people from Mr. Harris and Miss Jacqueline's class. I don't know. I know for a fact Miss Jacqueline's class, you guys haven't got to chapter 7 yet. You guys have gotten to chapter 4. Is there anyone from Miss Jacqueline's class in here? Anyone?
Did
Okay.
you say Mr. Walker's has the direct write-off method?
I don't know exactly. I just work very closely with Miss Yeager
Yeah.
as her embedded tutor, but I help everyone. So. But in the case of anything, know that direct write-off method is not GAP approved. You guys do need to know that.
It's for immaterial things, right?
It's not GAP approved at all.
Oh, okay.
A lot of small businesses still do that, but that's personal knowledge and that's not testable knowledge. The testable thing, if you ever see it on the test where it says, hey, is a direct write-off method gap approved, you would automatically just say, nope, we don't do it. We've never heard of her.
We don't know who she is.
We don't know who she worked for. You're not one of us. So, but what we do know, yes.
What if you're making a contribution to charities?
So contribution to charity would be something completely different from account receivable, I believe. So a contribution to charity is usually expensed out, and that way it's noted for things like for things like taxes. So I don't believe, I'm trying to run through my head in case that ever comes up through this course, but I don't believe that's gonna be coming up in this course unless you take a tax class. But as far as that, yeah, I don't think so. I'm trying to think of everything that deals with charity within there.
Oh, we've run through so much, that's just one, I think that's like we haven't covered.
Yeah, of course. Might as well like go through it.
No, unless I ask.
There's no wrong questions. Anyway. So my mind's like going off in mile minutes. So, yeah, the biggest thing is to know that it violates GAAP. Now, the allowance method, what are the three accounts we're going to be circling around this over and over again?
Allowance for doubtful accounts.
Allowance for doubtful accounts,
Credit.
bad debt expense. Net what, the net revenue, or not revenue, net receivables isn't really a count, but it is a equation you do need to know. So I'm gonna put that to the side right here because that's perfect. We're going into the next. All right, and what's the last account that we circle around whenever dealing with the allowance method? Accounts receivable. So I put them in this order specifically because if you remember them in this exact order, you have every journal entry at your disposal. If you hide accounts receivable, you have the exact journal entry for writing, for doing any adjusting entry. If you hide bad debt expense, you have every journal entry for write-off. Let me write it down. Why is it freaking out on me? So if you were to cover up completely accounts receivable. So actually. If we were to cross this out. These two basically make up top the adjusting entry for whenever you're adding more into your allowance for doubtful accounts. If we were to cover up bad debt expense, you have the exact journal entry you need for a write-off. Does that make sense? Awesome. I'm always a fan of tips and tricks. So. To start this off, I'm going to write a problem down on here, and I'm gonna have you guys, I'm gonna give you guys 5 minutes to solve it. And then we'll go over it. I'm gonna try to leave this guy up here. So D is relevant.
Oh. Right.
We are on chapter 7, and we're gonna be working through a problem. So the first part is up. What I need you guys to do is just get to the journal entry for the adjusting entry for the first one, and I'm about to make another one where we're gonna say we have to actually write someone off. Both pieces are up there. I'm gonna give you guys 5 minutes. Huh? And if anyone needs any help, just raise your hand and I'll come right over. All right, come right over. So I did this separate. Step 1 is recognizing what's in. So what account we have. Have a good one.
Thank you.
Okay, so if it's gonna be just.
Yeah, that's like the first and second. I'm saying this.
Whichever way works best. Just know this is it. This is not a journal.
Analyze.
Yeah.
Oh, I didn't realize that was. Let me move that. Sorry, y'all. I'm trying to be. So you're gonna make the journal entry for adjusting your allowance for doubtful accounts. And then you're gonna make a journal entry for write-off. So you will have to do math, a lot of math, well, not a lot of math, but some math for the first part, because you have to figure out, okay, how much am I adjusting?
Yeah.
And then you have to figure out, okay, how do I write a journal entry to adjust? So what's a journal entry to adjust? Perfect.
Yeah, I know. Okay, yeah.
And then you just have to figure out, okay, how much do we have to fix, how much do we have to do? Which you have to look in your allowance without book count first, and then you have to, go over and figure out, okay, what do I need to make? We're doing the accounting supervisor.
Yeah. Wait, so one more time.
We're doing the accounting supervisor method where you'll look at the APA, which will have a current balance.
Yeah.
Make sure you have P charts.
Yeah,
And you have to figure out, okay, what's the ending balance and what do I need to make it an ending balance?
yeah, that makes sense. Oh, okay.
You have a perfect exact spot, you're gonna make it so much, right? Basically, you have a perfect number here, all you have to do is just fill out the bad debt expense. Debiting and crediting allows for deficits.
Oh, I did, yeah, I did that. So I did because my dad did that. You gotta write it.
Wait, why that?
Because that's, take this, you have a water bottle, 600 is in it, but the water bottle. You need perfectly is 5,160. That's how much you fill. Yeah, that's right, they're kind of. I brought the over out first, and I'm just blowing around. Yeah, you're good, you're good. So, we have this, let's start. This might be better visualized to make a key start out. So at least for ADA specifically. Make a key start first. And, where's the credits? So, how much did it make you? Right, and how do you find?
Did you say 72,000?
You take the accounts table, times by the. And that's your only. So there you have the middleman. And I'll give you that.
So that thing, which is asking you to figure out what the number is.
That's what it is.
It's pretty complicated, so I can imagine this.
Yes.
So now then, since we calculate 28% for,
Yeah.
I'm
actually gonna walk through it right now.
that's like part of it.
Yeah.
Yeah, so that's, and then here, and this was, yeah, that's the. So she already has 600. I'm kind of, yeah.
Right
I
after.
probably did last week, I like my.
Yeah.
I'll do the one that we have for the notes. And then now I think you have to.
You're on perfect draft, you just need to. This is not. Oh, sorry. That's what I put right. I noticed you guys were doing that first, so don't release on the test because unless you. Because.
Yeah, bad debt expense. So after I calculated, like 5160. What do I do from there?
You gotta, yeah.
Okay, so and then I will debit. Debit on the bottom, right?
Yep.
Okay, I will debit. Allowance. I don't know. Overhead. Yeah, bad debt.
So that's what we're.
Okay, so I would like 5160, that bad debt expense, right?
So it's gonna be actually the ending balance. So that's what you guys did. You wanna make it your perfectly ending balance? Yeah. Do that visually.
Yeah, and then I would, so I would.
So
credit
from 600 to 5,760.
Right, well, and then.
Yes, because this is
But
gonna be.
is-
the amount of thyroid.
Is that balance?
Basically,
Like,
when you're,
that's fine.
what we're doing, we're saying, all right, if you're.
Yeah.
That's 600 by credit, and that.
No.
Actually down
Yeah,
here.
essentially it's for rebuild. It's like a refund.
Okay.
That's fine.
Saying, all right, it's 600 full.
That's what I'm talking about, right?
Well, you get it to 5,000 first. They got water bottles. Now, also switch left, come back to the phone. That helps.
Yankees, oh my gosh.
I ain't saying you.
Bro, no, come on now.
You're good, you're good. Bro, let's take this right on it. Now this thing has, I made a mistake awareness. So it would keep it going.
Went over your head, okay.
So I know that like how much I like and stuff, I don't know how to.
So,
Yeah.
take a wild
Like I was
guess.
thinking it in class, every single.
Okay, like if we're working right now. Okay.
And so you just need to find that X between these. Find that X.
And then. Yeah.
For your home. So like your debit card.
Oh,
So we have the accounts in top left.
well, for this one, I just indicate that, yeah, it's this one, this one, and that.
Oh, got you.
Well, yes, it's one of the-
Okay, I guess what do you do after the city or the journal?
As it.
That's gonna be for rides.
You, because look, you deposit, you deposit, you show the fact you made the deposit.
Just think about it, we're not trying to mess with our conscious people right now, we're trying to fill up the allowance account. We're gonna be using it.
It makes sense. Yeah, no, it makes sense. I feel like, I mean, it could be, the next question would be the next step, right?
Maybe.
If like they ended up not being.
Sure, why not? Actually, let me get practice.
Yeah, that's probably gonna be next.
So,
Yeah.
I'll set like after.
On the right side, you're very right. Because you, all you gotta do.
Thank you. I'm trying.
Yeah.
You're up. So I see what you're doing here. So what you wanna do is first get to your bottom. So this is gonna be basically running.
How you do it, you could just.
First off, we're saying here, here's your EDA, 600. We're wanting to make this your bottom. So I hear that. Maybe word for good.
What about like some people running half forward?
It would go actually on the left.
How this question scenario.
Think about it, when you're writing off an account, you're using up this historical balance to credit, but it lowers or right.
Yeah, it's like if it's really hard, big, like, so not this question, but the
This
next
is gonna
question, right?
say,
Like,
stay over here,
if
because
somebody
this
sends
is
it off their debt,
is an estimate.
you have to rewrite.
Oh, yeah.
Journal entry.
Or this whole account is a basic estimate of saying, we think this is gonna happen.
Well, I guess.
We don't know for a fact it is, we think it is.
You're either gonna pay us all of it or. But like, why would it come, the company that.
Some companies will leave, like,
Yeah.
they're just gonna add it on to your bill for like next
Yeah,
time.
I'm good.
Just gonna add it on. It's the customer comes.
Yeah, I have too much.
Doesn't want one.
Yeah, cause you're getting all your money. You think like, you want to, like, it's like,
You need to make your own.
yeah, like you're getting receivable.
There was the one with the ABA and stuff like that.
So.
What's the-
I don't.
That's for nine.
That's gonna be a problem.
Also, have y'all been here, like, the majority of these?
Oh, yeah.
Eighty for bad debt, 88.
This is my.
All right, how y'all doing?
It's very helpful.
We're up there in the past.
That's it.
Perfect.
Okay, and I feel like it's the queen lane.
Yeah.
Yeah.
Literally.
It's just like.
Great, I need to make the class. Yeah. So you gotta pick a debit credit.
Oh, like. It's right there.
Yeah, so which one's gonna be debited, which one's gonna be credited, and the same thing's gonna be when you.
Right. Two.
One second, I'm gonna set him up real quick, and I'll come over. We're gonna do that after. Right now, it's just gonna be exam study, and we're just running all through this.
I'll probably be here more often. I mean, it's used.
So- I'm gonna start running through this problem. I know this is a very confusing one. Because we all love back to seven. We're gonna move that,
Yeah. Yes.
move this up. So if the nature of this, instead of asking you, doing a call and response, I'm gonna just work through this step by step. If someone finds that they got something that I did not, raise your hand and we will explain through it. So step one, when you're going through these problems, I'm gonna make this a little bolder. So step one is finding out, okay, what's in each account? Currently, we only have ADA and accounts receivable. We know for a fact our balance in accounts receivable is 72,000. And we know we have a beginning credit balance of 600. Step two is finding out the percent of accounts receivable is uncollectible. So you take 72,000, you times that by 8%. And can anyone give me that number?
5,760.
5,760. So this goes to the very bottom of our allowance for doubtful accounts. We're basically saying here, for step three, we know that we need to get to 5,760, but we're not there yet. We have to figure out what this X is, because you cannot just jump from one number to the other. So we instead take 600 and minus that out from 5,760. And that goes to our X. Any questions so far? So step 4 is making that journal entry. Everyone? You would take bad debt expense and you would debit that for 5,160. And then you would credit ABA for 5,160. Any questions? That's it. So that's everything for step 1. Yes. Because what we're doing here, basically the essence of what we're doing is we're expensing in the time frame that we get. This is the expense. Yeah, of course, y'all have a good one. This is under the expense matching principle. So we're basically saying, all right, we got this money, we're going to receive this money, but we don't think we're going to earn as much as we thought. So we're expensing it here and now today, saying, all right, it's expense today. We have a little allowance account.
Attention. Room equipment usage has not been detected.
Yes,
If you were still,
I don't know. I was warned about that, but I did not expect it.
So bad debt expense will always be negative.
Yes, in this case, where we're doing an adjusting entry. This is why earlier I was saying, all right, remember these 3 accounts in this order. Because if you cover accounts receivable, this is your adjusting entry. And what we're doing down here is an adjusting entry. So think of, okay, we're adjusting accounts, we're adjusting our allowance account. It's the exact one you're looking for. Any other questions on this? Perfect. Now, we're going to do a write-off. Yes.
So 5,760 would be that 600 already allowed plus the 8%.
Got it, perfect. So. It won't let me scroll out any further. So we're gonna cover up problem 1, but we're gonna keep all the math there. We know Bob has went bankrupt and we will have to write off his account of 400. This one I will ask you guys, what are we doing here? Writing off. So what's our journal entry?
ADA is better and, I credit to.
Just putting that there, just to kind of help explain things while we're crediting accounts receivable. So, any questions on this? Yes,
Are we expected to do that? Like,
Yes.
right with the, like, subsidiary?
no, I'm just putting that there just to kind of indicate why it's accounts receivable, because it is Bob is a subsidiary of accounts receivable. And if we were to look at this through the T charts too. Gonna get into the nitty gritty here. I'm actually keeping this up here, so we get to see everything. We have 72,000. And now we're expensing out, well, not expensing out, but we're losing 400. So we have 71,600. Over in ADA, we have now our new total, 5,160, and we're losing 400. So that's kind of it visualized through T charts. Now, something fun that we go over is the net realizable value. So we're gonna take problem 1 and figure out its net realizable value. Can someone tell me the formula for that?
Accounts receivable minus ADA.
Accounts receivable minus ADA. So we know our account receivable right now is 72,000. Our ADA is 5,760. That will equal. So for the next set, though, now that we have a write-off. We know our accounts receivable is now 71,600. And our allowance for doubtful accounts is 5,360. So one great way to check your work is by doing the net realizable value before and after, because it's always going to be the same under the allowance method. The reason why is because both your accounts receivable and your ADA have went down together, meaning that nothing changes for the ending value. Yes,
Didn't we get 5,000?
the write-off.
Oh, yeah. The tables.
Huh?
The tables, that's when you got them.
Yeah, so I use the table to kind of demonstrate, okay, what's happening. Because these journal entries basically dictate what happens to the tables. So we see over here where ADA was debited 400, so we debited 400 over here. And then we credited accounts receivable right over here. That makes sense? Yes.
On the test, if we have a question similar to this, what would be like our answer bit?
The answer bit would be this journal entry. That's why at the end of this, what I was asking for the answer was the journal entry. Now, if you were specifically asked for net realizable value, then your journal entry would be, not your journal entry, your answer would be this net realizable value. Yes.
Did they ask, like, did she ask, question like, if you give me the net realizable value before write-off?
Yes, she possibly can, but in all honesty, as you see, if you do it before or after, you're gonna find the same answer. So honestly, I know for a fact you will need to know how to get to net realizable value. I forget if it's going to be as complex as asking before a write-off. I think it might be after anyway, so it won't be too bad. Just remember, honestly, just read through the question slowly. Did this make sense or is this still confusing? Sense?
Why does that, the second one, the NRV match the top one again?
So it's because both accounts receivable and allowance for doubtful accounts decrease. Since they both hit a decrease, they both ended up the same way. So, any other questions on this? This is going to be the same formula every time for this kind of question. So knowing the basic steps of how to get there, just memorizing these basic steps and memorizing, okay, the journal entries and exactly what they mean. This is our adjusting, this is a write-off, and knowing exactly how to find the net realizable value, that's gonna be key to the test. Have a good one. The last thing in chapter 7 is notes receivable, and that one's not too bad. Have a good one.
That's the one we just multiply, right?
That's when we just multiply.
Awesome.
All right, I'm gonna erase this. Does anybody still need this one up? Nope. So does anyone know the formula for a note receivable? Or define the interest of a note receivable? That's the important part. The time. So we got the time. What's the usual fraction you use for time? Have a good one.
What do you mean? Like, you're talking about for your days?
Year.
Uh,
Or
divided by 365.
360.
360.
Gotta think of the banker's year. So it's basically 12 times 30. So time, which is X over 360. What else do we multiply? Interest rates. Times. It's like the exact note receivable.
Oh,
Alright. But do you want to work on a quick problem on?
yes.
Yeah, sure.
Alright,
I remember 360.
huh?
Let's go. 360. It's like 95 points.
Quick.
By the way, will the questions like tell us whether or not they want us in days or in years?
It will almost always be in days for this one because we're thinking about like current note receivables. So more than likely, you're gonna be dealing with days, if not months. So if it ever asks for months, you'll know exactly how many months. So if it just says, hey, we need this back in 3 months, you know it's 3 over 12.
Right.
If it says, okay, we're gonna need this in 90 days, it's 90 over 360.
Okay.
Right? We wrote a note for $10,000 with the terms of 120 days and an interest rate of 5%. Give me the interest, the total interest and the total payment on maturity date.
Okay, so. Total interest and maturity date?
Yep, and total payment on maturity date.
Adios,
Huh?
Adios,
I will round it up to like the, just like a normal dollar amount.
Okay.
So like, 2 decimal points. Yes.
That's where it's one.
So 120 over, so 360 is the dates, and the reason why we do record dates is because the days of year always change, so just, you know. Why is it everyone does it?
So we are finding two other things.
We're finding 2 things. One is the interest and one is the total payment.
Okay, interest, no payment, okay.
I'm gonna do this. 2. So, can anyone give me the interest amount?
Yeah, 166.67.
Perfect. Did anyone not get this amount? Glad to hear. And what's the total payment?
10,166.67.
Perfect. And that's how you do note. And now we've successfully ran through every single chapter and everything that'll be on the test.
You're available 4 to 5 tomorrow.
I'm available for, yep, I'm gonna be here till 6 tomorrow. So let me see real quick.
Wait, where can I find you tomorrow?
So if you, for single appointments, there's the personalized Campus Connect link on Miss Yeager's page. Otherwise, everyone else just has to go through Campus Connect to find me, or go up to the welcome desk that you guys had to check in at and just say, hey, I want to schedule an appointment. And you'll be able to schedule an appointment there. I think. Yep, so I have availability of 4 to 4:30, so I'll make sure they get.
Put me in, please.
Huh?
Put me in, please.
No worries. I do have 30 more minutes for this.
I was gonna ask if you could go through this kind of what questions do I have? No problem.
Don't want that stuff your homework if you want. Yeah, just put them over. You will grab them up one way or the other.
Real quick. I'm gonna see if I'm able to just do the appointment scheduling right here for you, so you don't have to worry about that.
But also from some of the state problems.
Everyone was
Gonna have, and then up here with you tomorrow in 30 minutes.
Well, to that one, I think everyone needs.
Sometimes that happens, and then I have a study guide, and also we officially have the YouTube up. And I'm posting this one unedited, so I'm just throwing this up tonight, just so it's out there. Because I know if I try to edit it, it takes me hours.
Is what it
It's just frustrating to me because. It's just, I just missed part of it, that's all. So I'm just gonna
All good.
down, work some of the work problems that are in there and,
You all have a good one. Definitely.
thanks for your help.
Of course, of course. No, honestly, it does just say continuous practice. Accounting is its own language and it's tough.
It is. I knew this is gonna be a difficult semester because I've got microeconomics, statistics, and accounting as 3 classes that I've never taken before. So everything was just brand new.
Microeconomics is hard. I took that last.
Oh, yeah.
semester.
I've found that micro was more difficult for me than, macro was more difficult for me than micro so far.
Really? A lot of people say opposite.
I guess it's what you relate to, at least with the micro, I can see where we're going with the macro. It's like,
Yeah.
learn this, do this equation, learn this. Do this
There's
equation.
a lot of formulas. Yeah, it's kind of hurting me right now.
Oh, what
I'm
I'm showing
taking
them too
macro
is gonna
right
be
now.
journal entry.
Oh, okay.
So the journal
Hey,
entry
Cosmos
would be
theory.
like, okay,
He's
there's
good,
the
but it's
cash.
difficult
That's how
because
much cash we
the
got.
language
But you have to put like
Yeah,
interest
that's who I
revenue
have.
and then
Got to
a
put
note
extra attention just to
receivable.
Make sure that I can understand.
So I have to do a journal. Well, it keeps my brain focused,
Yes.
not
Like
wandering.
This is on me.
Yes.
I,
Yeah, he's a good teacher though.
He is, and because he cares about the students.
Yes, that's one thing I love about a professor is when they care.